In 1965, Warren Buffett took control of a failing textile mill worth $19.46 a share. Today, that same company is worth over $600,000 a share. Somewhere in that 58-year gap is the actual mechanism, not the luck, not the myth, the mechanism, and Buffett wrote it down himself every single year in letters most people have heard of, but almost nobody has actually read. Here's the strange part. This isn't locked in a business school archive or sold as a $2,000 course. It's public. It's free. It's been sitting online for decades. And the reason it stayed hidden in plain sight is the first thing this video is going to explain to you. A law professor named Lawrence Cunningham did something almost nobody else bothered to do. He read every one of those letters, pulled them apart by theme, and reassembled them into what serious investors now quietly call the closest thing to a Buffett owner's manual. Not a biography, not a highlight reel, a dossier on how the mind behind the greatest compounding machine in market history actually makes decisions. Two things are going to stick with you by the end of this. First, why this education has been sitting in public view for 60 years and still gets ignored by almost everyone. Second, the one-lay career idea Buffett drops that quietly rewrites how you should evaluate every financial decision you make from here forward, personal or corporate. Stay until the final section, because that second answer only fully lands there. If the book vault gives your thinking a real edge, subscribe now. We build these for people who refuse to stay average. The strategic breakdown. The Owner's Compact. Picture this. You hand a stranger $50,000 to manage on your behalf. Now imagine you find out that stranger has none of their own money in the same investment, none of their own risk, all of your exposure. Would you still trust their decisions the same way? That's the exact situation most shareholders are in every single day, and almost none of them notice. Buffett noticed. In his letters, he draws a hard line. The company may be structured as a corporation, but he runs it like a partnership, because a partnership can't hide behind paperwork. He tells Berkshire shareholders plainly that they deserve to hear directly from the CEO about what's actually happening in the business, not a filtered version built for optics. Try asking your own bank or fund manager for that kind of transparency and see how far you get. Buffett's fix for this is almost embarrassingly simple, which is probably why nobody copies it. He insists that board members put a serious chunk of their own net worth into the company they oversee, what he bluntly calls eating your own cooking. The moment a director's own money is on the line, the theater stops. Real incentive shows up, and once you see this pattern, you'll start noticing its absence everywhere, in every fund, every board, every advisor who's never once told you what they do with their own money in your position. In the Compounding Quality interview, Lawrence Cunningham confirmed that Buffett's best decisions were always personnel decisions. The governance section of this book makes that crystal clear. Every business failure Buffett observed traced back not to market conditions, but to the wrong people making decisions with other people's money. And what I am about to reveal next is a single test that separates every good capital decision from every bad one. A test most CEOs either ignore or have never been taught to apply. The Capital Allocation Briefing. The section on corporate finance and investing opens the deepest line of inquiry in this entire dossier, and it begins with a deceptively simple idea. Buffett asks one question about every dollar that passes through a business. Does keeping this dollar create more than $1 of value for the owner? If the answer is yes, retain it. If the answer is no, return it. That single test, applied with ruthless consistency, separates Berkshire Hathaway's capital compounding from the rest of corporate America's chronic value destruction. Here is what most summaries skip entirely. Buffett introduces the concept of owner earnings, distinct from the accounting earnings that appear in income statements, the real, tangible economic output of the enterprise, not the number an accountant reports or a CEO uses to justify a bonus. What I am about to tell you is the part of this book most people never even reach. Buffett demonstrates that reported earnings and owner earnings can diverge so dramatically that a company appearing profitable is actually destroying wealth in real economic terms year after year while shareholders applaud the results. The terrifying part is that most people never notice this pattern happening to them. Buffett shows how managers who want to expand their domain at the expense of owners make capital allocation decisions not based on shareholder returns, but on institutional prestige, personal legacy, and what he calls the institutional imperative, the gravitational pull inside organizations that causes management to imitate competitors, pursue activity for its own sake, and resist clear-headed analysis of whether a decision actually creates value earnings should be retained only when the capital retained produces incremental returns equal to or above what investors could get elsewhere. Otherwise, the money belongs to the shareholders. You have probably felt this dynamic without naming it. You've watched organizations grow headcount, launch new initiatives, and celebrate press coverage, all while the actual return on the underlying capital quietly deteriorated. Buffett's capital allocation framework gives you the language and the lens to see it happening in real time before the damage is done. And once you understand this framework, a much darker pattern of mergers and acquisitions becomes unavoidable to notice: the Acquisition Autopsy. The section on mergers and acquisitions reads like a forensic report on the crime scene that repeats itself across every decade of business history. Buffett opens with a brutal observation: bad acquisitions almost always share the same motive, the CEO's desire to do a deal, not to create value, not to strengthen the business, the desire to be seen doing something large and transformative. And investment bankers, whose fees depend on transaction volume, are always ready to provide intellectual cover for whatever price the acquiring CEO has already decided to pay. Buffett identifies the institutional imperative at work here too. When one major company makes a large acquisition, competitors feel compelled to respond in kind, not because the economics justify it, but because standing still looks passive. The result is an entire industry overpaying for assets simultaneously, transferring billions from shareholders to sellers, while the deal architects collect their fees and move on. Most people read this as strategic consolidation. Buffett calls it by its real name: a wealth transfer from buyers to sellers, engineered by advisors paid to ensure the transaction happens regardless of the outcome. Inside the vault, we call this the acquisition illusion, the gap between the press release story and the economic reality that follows. Buffett describes how pooling accounting in the 1960s let acquirers manufacture rising earnings per share through deal velocity alone, without any real business improvement. Wall Street celebrated these conglomerates. The press lionized their CEOs, and then, one by one, those empires quietly unraveled. What comes next is the part most readers never forget, because Buffett doesn't stop at the autopsy. He offers the alternative: simple operations he can understand, favorable long-term economics, honest and capable management, and a price that makes sense. Not every business, a small, carefully selected few. The discipline to say no to almost everything is, paradoxically, what makes every yes so powerful. But none of this matters if you can't answer one question honestly about the business you're buying. The next section forces you to answer it: the common stock verdict. Buffett's central argument here is almost offensive in its simplicity. A stock is not a symbol on a screen. It's a fractional ownership interest in a real business. If you wouldn't be comfortable owning the entire business, you shouldn't be comfortable owning a single share of it. That reframe, genuinely internalize, eliminates most of what passes for investment strategy in popular financial culture. The deeper layer most readers miss is Buffett's critique of modern finance theory: beta, volatility, diversification across hundreds of positions. He dismisses these not because they're complicated, but because they measure the wrong things: price movement instead of business quality, correlation instead of competitive durability. Lawrence Cunningham has confirmed in multiple interviews that this is precisely where Buffett's letters diverge from what most finance professors still teach. Here's the confrontation most investors aren't ready for. How many positions do you currently hold that you couldn't explain the fundamental business of if someone asked you right now? Buffett's circle of competence framework isn't a philosophical suggestion. It's a hard operational boundary. Invest only in businesses you genuinely understand. The investors who lost fortunes in every major downturn didn't lose because markets fell. They lost because they owned things they didn't understand at prices they hadn't genuinely analyzed. Buffett's margin of safety: buying at a real discount to intrinsic value, is the insurance policy for when reality diverges from expectation. Once you accept this framework, it's liberating. You stop trying to predict markets. You simply evaluate businesses. And when a business you understand becomes available below what it's worth, you buy with conviction and hold with patience. Now we arrive at the section where the numbers themselves go on trial: the Valuation Chamber. Let's make this concrete. Imagine two companies that both report $10 million in annual profit. On paper, identical, but Company A needs to spend $8 million every year just replacing worn-out equipment to keep running, leaving $2 million an owner could actually pocket. Company B needs almost nothing to maintain itself, so the full $10 million is real, extractable cash. Same reported number, wildly different businesses. That gap is what Buffett calls owner earnings, and it's the number that actually matters, not the one accountants report, the one an owner could genuinely take out of the business without damaging it. Now stretch that same idea across an entire portfolio. If you own small slices of 10 different businesses, most of them don't pay out all their profit as dividends, they reinvest it. Buffett calls the sum of your real claim on all that retained profit look-through earnings, and it's how he judges Berkshire's true economic engine instead of just what shows up as income on paper. And there's one more disguise to watch for. When a company overpays to acquire another business, the excess shows up on the balance sheet as goodwill, an accounting entry. But real economic goodwill is something entirely different. It's the actual pricing power and brand strength a business has earned in the real world. One is a number created by an overpriced deal. The other is a genuine competitive weapon. Confuse the two and you'll consistently overpay for businesses that only look strong on paper. Buffett's definition of intrinsic value ties all of this together. It's the discounted value of the cash that can be taken out of a business during its remaining life. He illustrates it with Aesop's old idea: a bird in the hand is worth two in the bush. Investing is simply the exchange of one bird in hand for the promise of more birds in the bush. And the entire question is how certain you are about those future birds, how many there will be, and how long you'll wait. That's the whole framework. Everything else is noise. And the final section of this dossier delivers the verdict on the most dangerous deception of all, the Shenanigans Verdict. The closing section of our case file, covering accounting policy and tax matters, is where Buffett drops the pretense of politeness entirely. This section reads like a private briefing on financial manipulation, pattern recognition drawn from decades of watching how companies use the flexibility of accounting standards to manufacture the appearance of prosperity. Buffett identifies stock options as one of the most egregious instruments of shareholder wealth destruction in corporate history, a real compensation cost, systematically excluded from income statements while its full weight is borne by shareholders through dilution. Most financial media treats options as an incentive alignment tool, a way to make executives think like owners. Buffett's analysis reveals the opposite. An executive with options benefits asymmetrically from upside while facing no corresponding downside. A true owner suffers equally in both directions. Options create the appearance of ownership psychology without the actual risk of it. Enormous compensation transfers disguised as performance alignment, while shareholders absorb both the operating risk and the dilution. Buffett also dissects restructuring charges with a kind of calm fury that's more devastating than anger. Companies routinely use one-time restructuring charges to bury ongoing business failures, declaring exceptional costs that are, by definition, never supposed to recur, and then recurring precisely on schedule, the next reporting period. The pattern lets management report improving core earnings while the underlying business steadily deteriorates. Auditors approve it, analysts accept it, shareholders never see it until the damage is irreversible. Key lessons and insights. Think like an owner, not a shareholder. The first lesson this book quietly teaches is the radical difference between thinking like a shareholder and thinking like an owner. A shareholder monitors a stock price. An owner monitors a business. Buffett built Berkshire's entire communications and governance philosophy around this distinction, writing letters that treated every reader as a partner with a genuine interest in the honest economic truth of the enterprise. This isn't philosophical decoration. When you evaluate a job offer, you're evaluating an owner's share in an enterprise. When you start a company, you're building something that must justify the capital retained inside it. When you invest in any asset, the only question that matters is whether the underlying economic engine justifies the price you're paying. If you leave with nothing else, let it be this: the language of stock prices is designed to obscure reality. The language of business ownership is designed to reveal it. The institutional imperative is the invisible enemy. The second lesson, and arguably the most psychologically dangerous insight in the entire book, is what Buffett calls the institutional imperative, the invisible force inside organizations that drives management to imitate, act, expand, and spend simply because other organizations are doing the same. Buffett identifies this as the primary reason intelligent people repeatedly make the same terrible capital allocation decisions across generations. You are not immune to this force. It operates in every organization and in every individual who measures their progress against what peers appear to be doing. The antidote is the discipline of the independent standard, asking whether a decision creates genuine value for owners, evaluated in isolation from what anyone else is doing. That requires the courage to live passive or conservative in the short term in exchange for being provably right over years and decades. Intrinsic value is the only number that matters. The third lesson is Buffett's uncompromising insistence that intrinsic value is the only number that ultimately matters in any investment or business decision. Book value can be manipulated. Reported earnings can be engineered. Stock prices reflect sentiment as much as reality. But intrinsic value, properly calculated, is the cold, unforgiving measure of what a business is actually worth to a rational owner who intends to hold it. Remember the question we opened with: why this education stayed publicly available for decades and yet remained largely ignored? This is the answer. Calculating intrinsic value requires work. It requires genuine understanding of a business and the discipline to think in years and decades rather than quarters. Most people are not willing to do this work, and that unwillingness is precisely what creates the opportunity for the people who are. Accounting is a form that can be manipulated. The fourth lesson is one Buffett frames almost as a warning label on every financial statement ever produced. Accounting is a form. As a form, it can be manipulated, frequently not illegally, frequently not even unusually. It's simply the natural result of letting the people who benefit from reported results choose the frameworks used to produce them. The practical application starts with a habit. When you read any financial report, ask one question first. Does this number reflect what the owner of this business actually receives in real economic value? If the honest answer is that you don't know, that's the most important data point in the entire document. The gap between what's reported and what's real is exactly where fortunes are made by those who see it and lost by those who don't. Management integrity is the foundation of every investment. The fifth lesson is the one Buffett returns to more consistently than any other across 50-plus years of writing. Management integrity is the single most important variable in every investment decision. Intelligence matters. Energy matters. Strategy matters. But without integrity, an intelligent, energetic person will simply find more sophisticated ways to extract value from others rather than create it for them. And that brings us to the late career idea we promised at the start, the one that rewrites every decision going forward. Every principle in this book converges on one operational truth. The quality of a decision is determined not by how it looks in the moment, but by whether it genuinely serves the people who actually own the enterprise. That standard, applied consistently across a lifetime, is how a textile mill worth $19.46 a share in 1965 became one of the most valuable enterprises in human history. The vault closing. So there's the full case file: boards without skin in the game, capital allocated for ego instead of returns, acquisitions dressed up as strategy, numbers built to flatter instead of inform, 5 different crime scenes, 1 shared cause. Every failure traces back to the same root. The moment ownership and control get separated, someone always steps into that gap, and it's rarely in your favor. The fix isn't a new regulation or a smarter accountant. It's simpler and harder than that, an owner's mindset, applied without exception by everyone who hands their money to someone else to manage. That shift, from passively watching a stock price to actively thinking like an owner, is the real argument running underneath every essay in this book. What makes this book genuinely unusual, and what Lawrence Cunningham understood when he first assembled it for a symposium at Cardozo Law School in 1997, is that it isn't really a book about investing. It's a book about rationality in the face of institutional pressure, social conformity, and accounting manipulation. Every section, from corporate governance to tax matters, is the same investigation from a different angle. Is the economic reality of this enterprise consistent with what's being represented to the people who own it? That question is as relevant to a small business owner as it is to a portfolio manager on Wall Street. Here's your move for the next 7 days. Take one financial document you've recently received, a statement, a business plan, a performance report, and apply the owner's lens to it. Ask whether the numbers reflect real value being created or extracted. Ask whether the people responsible for those numbers have their own interests genuinely aligned with yours. Ask whether the decisions being made with that capital would pass Buffett's single test. Does retaining this dollar create more than $1 of value for the owner? You don't need Berkshire Hathaway's resources to apply this framework. You need only the discipline to ask the question honestly. Here's the question I want you to sit with. Are you managing your money like an owner or like a shareholder just watching a screen? Answer honestly in the comments. If this masterclass delivered real value, like this video, subscribe to the Book Vault, and drop your biggest takeaway below. You're part of a community of ambitious people who refuse to be deceived by surfaces. And in a world built on managed perception, that refusal is the most powerful unfair advantage that exists.